Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have David Page, head of macro research at AXA Investment Managers, to discuss inflation expectations and which asset class stands to benefit the most for 2023. David, it's great to see you. Welcome to Trade Talks.
Thanks very much, Jill. Nice to be here.
All right, and I guess the obvious question is, do you expect Europe and the US to fall into recessions as we head into the new year?
The short answer to that is yes, we do, sadly. I mean, I think from a European perspective, we are seeing quite a large energy shock come through. We're already starting to see quite an impact of those very large price increases, very high levels of inflation starting to eat into consumer spend. The UK, as part of the broader European backdrop, contracted in Q3. We think that's probably already in recession. We think that the Eurozone, including the larger economies there, Germany, France, Italy, will contract in the fourth quarter and will be contracting in the first quarter of next year as well. So we do expect quite a sharp recession come through over the couple of quarters for the Eurozone there. We are then expecting, as we go into the spring, to see positive growth. So it may be relatively sharp, but relatively short. But we are expecting recession across Europe. The US, I think, is a much more nuanced call. On balance, we do look for recession there, but it's not the same dynamic. It's not an energy shock that's driving a contraction. Rather, it's the tightening in financial conditions combined with some of the pressures still from real disposable incomes shrinking and higher levels of inventory, but it's a much tighter call. We forecast a recession there. We think it'll probably start in the first quarter of next year, and we think it'll be relatively mild by contrast as we move into the second half. Probably just about on balance, we see a contraction in Q3 next year as well, but as we move to the fourth quarter, we're expecting to see positive growth return to the US.
What are your expectations for inflation in 2023 and 2024? When do we think we should start to see it retreat?
Yeah, well, I mean, we do expect to see quite a material drop in inflation, particularly next year, and we think that will continue into 2024. So thinking the US first, we think actually we've already seen the peak here in June. We also think that probably the October print started to show us that the peak has been achieved in core CPI as well. And if we think about, the very significant increases that came through in energy prices from October 2021 through to spring 2022, those base effects are going to see quite a material drop in headline inflation come through. But as I say, there does seem to be some evidence that we're seeing a fall in core inflation as well. So we forecast inflation to fall back very sharply over the first half of 2023, but then probably leveling out. And I think that's going to be the key issue for markets. Markets are expecting to see a very steep drop in inflation. We think it'll fall a lot, but we still see it averaging about 5% next year, probably closing next year around 4%. Before falling back towards target more slowly over the course of 2024. In Europe, I think inflation comes down a little bit more quickly in 2023 because it was driven higher so much more by this energy shock and less by the domestic demand conditions that we're seeing coming through. But again, I think as we move towards 2024, it'll be a little bit of a challenge for the Eurozone to get inflation back to the 2% ECB target.
How do you expect Fed policy to shift?
So we think that we're getting close to the peak now. We're fully expecting the December meeting to show a slowdown. We'd been expecting that for a while, but that was pretty well flagged, I think, from the November meeting, from the minutes, and from comments from Fed Chair Powell just before the Fed went into purdah. So we're expecting a 50 basis point hike there. We then expect to see more material signs of slowdown in the labour market, obviously not apparent in the latest numbers, but we are expecting them over the next couple of months. We expect a further downshift, therefore, in February. We're forecasting 25 basis points in Feb, 25 basis points in March. That would take us to a peak Fed funds range of 4.75%, 5%. After that, though, we think that because it's going to take inflation a little bit longer to fall back, we are expecting to see the Fed on hold throughout 23. So where markets are looking for those cuts to start in the back end of 2023, we think the Fed will probably hold out a little bit longer, and we think that the rate cut cycle won't start until 2024.
And finally, David, which asset class stands to benefit the most with this backdrop?
So we're very interested in the fixed income backdrop for now. We still see some concerns with regards to risk assets more generally, but I think looking at the fixed income class as a whole, while the pull to par is a definite attraction for us, I think it's the short end of the market that we're looking at. Short duration fixed income, including some of the short duration investment grade, and to some extent short duration high yield as well, should benefit against the backdrop where we're seeing inflation starting to ease back quite materially, the Fed starting to peak, but it doesn't necessarily take some of those risks that longer duration assets will hold. So we think short duration fixed income is our area of choice.
All right, David, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino,
Absolute
Global
pleasure.
Markets Reporter at Nasdaq.